Hello and welcome back to Dukascopy TV. Now, as 2013 is well underway, I thought it'd be a good time to look at risk and yield outlook, particularly focusing on high yields in markets such as the bond market. Well, joining me in the studio to discuss all this is Laurent Perusset, who is the director at Barclays in Switzerland. Laurent, welcome to the studio.
Thank you for inviting me.
Now, you've recently written an article focusing on high yields, and you look back to when the financial crisis first started towards the end of 2007, beginning of 2008. What's been your overall assessment of high yields in markets such as the bond markets, for instance, up until now?
If you consider the last couple of years, more than that, 4 or 5 years, I would split into different periods. First of all, as you mentioned, the crisis. 2007, 2008, what happened? What happened basically is a big crash, all asset classes following the same pattern, correcting. And high yield, being very correlated to equity market, about 80%, fall by 35, 40% to some extent, depending the region, depending the sector. So that was the first period. The second period, as basically the situation was quite difficult, government being under pressure a bit, but also central bank trying to find the right answer to what happened in 2007, 2008, started to decrease interest rates. So we had this pattern where investors were afraid to re-enter equity market, variable assets such as commodities, real estates, and try to find the safe haven assets. So during that second period, we had cash and government bond, especially the long part of the yield curve, outperforming the other asset classes. Then you had the third period. During this third period, when interest rates fall close to zero, helped by central bank and government action, investors were looking for yield. And because of this scenario, this situation, they went for investment grade. So they basically, we have seen that via inflows, they invested massively in the investment grade area. During that period, or just previously, companies have restructured themselves. They have addressed their own problem. They have cleaned their balance sheet. They have deleveraged their balance sheet. So it was really a nice and good investment for the lambda investor, if we can call that an investor. Moving to the fourth period, investment grade were now close to zero again, like government bonds, yielding very poorly, and then investors were also looking and hunting for yield. That's why they choose to go for high yield instead of going back into equities, because of uncertainty of the market being still very volatile. So they choose to go and re-enter the high yield market dramatically. Which brings me to last year. In 2012, high yield have produced an incredible return. If you look only at the European bucket, you're going to find that European high yield have produced a 28%, more than that, return over the last 12 months. In the US, quite a similar pattern, a bit less, 16, 17%. So that's clear that investors choose to go for high yield during that period instead of re-entering massively the equity market.
Also in the article, and you mentioned there as well about investors in particular, opting for high yield. You also mention efficiency of investors, and you say that investors will need to keep an eye on such data as well as we go through this year too. What are some of the details of an investor making efficient decisions?
At Barclays, we have our own approach, and we are promoting a multi-asset class approach to our clientele. So basically, and it's basically what the industry is doing. But here, what we are looking for is the best asset class during a specific period, or trying to forecast the expected return per asset class, trying to find the best in class, the cheapest, but also the most expensive one. So today, and that is a bit my intention through the article I've written that you are referring to, is that high yield are very rich today. Why that? 2 or 3 points. First of all, yield. Yield, the US high yield bucket is yielding 6%, close to the lowest level ever. Default rate between 1 and 3%, close to the lowest level ever. Yes, spread on US high yield are still a bit above 500 basis points. Some might consider that as an opportunity. Yes, it is. In fact, at Barclays, Wealth and Investment Management, we are still promoting high yield and overweighting high yield in our asset allocation. But if you look after all asset class, and an investor who is looking to, try to have and to invest in the best asset class today would have to choose equities instead of going for a long high yield.
Can you tell me a little more about now the correlation between private and government debt returns and yield spreads and your overall assessment for 2013?
It's a short question. The answer is quite complicated. If you look after spreads, which identify the difference between investment grade and government, obviously, I see those type of spreads staying at the same level. Nothing really to be mentioned here. What is more important, I would say, it's the duration, how you position yourself, your portfolio in terms of duration. And here I'm a bit concerned. Why that? Because, once again, interest rates are close to zero. So the probability of having interest rate increasing, especially in the context where the economy is recovering, is higher. So be careful with duration. Not that confident that the long end of the yield curve are the place to be. Investment grade spread gonna stay low, so not very attractive on that side. For a fixed income investor in the fixed income different asset classes or sub asset classes, I would still favor high yield. But for someone who is looking for an optimal portfolio, I would switch this high yield into equities.
And the risks going ahead this year?
Yeah, probably we are in a recovery pattern, no doubt about that. We are optimistic. We see fundamentals, numbers, key ratio improving day and after day, week after week. So it is really the good time to take more risk in the context of a portfolio. But once again, what we are trying to achieve is to match the client needs, not to push the client to take a risk that he doesn't want to take.
Of course. Finally, we have the Dukascopy question, Laurent, where I ask you if I was to give you $1 million US right now, which of these asset classes would you invest that $1 million? So we've got real estate, equity, bonds, gold, cash, oil. I'm sure we've had guests on before who want to diversify their portfolio, but if you could pick one, where would you put it?
I would definitely pick the equity one for the next quarter or so. I truly think that it's going to be driven by flows, and we're going to see an institutional investor coming back into the equity market.
Laurent, thank you very much for coming into the studio today.
Thank you to you.
That's all we've got time for on Dukascopy TV right now. We've got further interviews coming up, though, later in the day and throughout the rest of the week. But until then, goodbye.